everybody, Jamie here, your favorite CPA and financial literacy coach. And I wanted to answer one of the most common questions that I get around this time of year. Now, I'm recording this in November, but you could start this earlier if you're an overachiever or later. But the big question I'm always asked is, what should I be doing around the end of the year related to taxes? This is often the time that we're thinking about that tax bill that might be coming our way later on. And I'm specifically going to talk to business owners and entrepreneurs here because the things that we can do, thankfully, we have a little bit more leverage in how we can make some trade-offs to really help us from a tax perspective. So I wanted to give a few of my favorite tips for tax planning as you're in the last quarter of the year typically. So first and foremost, I want to say that sometimes we think a little too much about the very short term. That is one mistake that I see made. Typically, it comes out of maybe a lack of cash flow, maybe worrying about the tax bill that is going to come our way come April 15th of next year. And so we decide that the goal is always, always, always to reduce taxes as much as possible in the current year. But in fact, that's not always the best long-term play. So I'm going to talk a little bit about why that's the case. The very first step I want you to take before you decide what to do and before you even listen to any of these tips is think about which year you are going to likely be in a higher tax bracket. Okay, that top end tax bracket when you're looking at the income taxes that you pay. So remember, as a business owner, right, you are going to pay taxes on your business profit. That's revenue minus your deductible expenses. So we're talking about profit here. And you can go look up the tax tables, and I can link them below as well to see what kind of that top end tax rate is that you're likely to be in. Now remember, you got to subtract all of those business deductions first and then add in any other income that you or your family might have. So if you are married filing jointly, you're going to take also your spouse's income, or potentially if you have other sources of income, rental income, investment income, things like that you're going to have to recognize in the current year, you want to include that too. So first thing is think about that for the current year and then think about it for next year. Which one is likely to be higher? And this is especially important for business owners because oftentimes our goal is to grow, right? Our goal is to grow. And if that's the case, oftentimes we're going to think, okay, next year we're likely going to grow even more, especially if you've had a trajectory of growing. So we're probably going to be in a higher tax bracket next year. Now, that's not always the case, right? Maybe you have some investments you're planning to do in your business next year that are going to impact your profits. Or maybe you had some one-off events in the current year that made your profits higher, right? So think about current year, what do you expect your total income to be? And next year, what do you expect your total income to be? The higher the income, the higher the tax bracket you may be in, right? So you want to find that out first and see if there is a difference in what those top end tax brackets will be. Why do I have you do that? Why does that matter right now? It matters because really, the answer to what you want to do that's going to be best for you long term is completely opposite depending on how you answer that question. So I'm going to answer it, right? I'm going to go over both scenarios depending on what you choose, okay? So first of all, let's go over the scenario that you really do want to lower your income in the current year, that you really do want to lower your taxes in the current year because next year, you are expected to be in a lower tax bracket. So if you're expecting this year to be higher, right? You have more income this year and next year will be lower, then yes, indeed, the first thing for you to be doing is looking for things that you can move up into the current year. What you do not want to do, and this is a big, huge warning label, okay? Do not do this. Warning, warning, warning. Do not spend money on things you don't really need and weren't planning on getting anyway just to save money on taxes. That's like spending $10 to save $2. You still spend $8 and it's still going to have an impact on your cash flow, right? It actually might make it harder for you to pay that tax bill at the end of the day. So if you are going to move expenses, if you are going to put more expenses in the current year to try to lower your profit, that's okay. That's okay to do that, but make sure they're things that you already were going to get anyway, things you already needed. So maybe think about expenses that you were going to pay out in January or February of next year. And how can you move those forward? Or maybe it's even prepaying software subscriptions and things like that, especially if you're on the cash basis of accounting, which most of you, if you're small business owners, likely are, which means that you get the deduction in 90% of the cases, you get that deduction when the cash actually goes out the door. Okay. Now, before you make a huge asset purchase or purchase a car or something like that, definitely sit down with an accountant because there are special rules for things like that around when you can actually take those deductions. So don't expect that just because you spent a whole bunch of money on buying a new machine or a new car that you're going to be able to take that deduction in this year, or that that's even the best thing for you to do. But I'm talking about regular expenses that maybe you can pull up a little bit to try to lower your taxes in the current year. On the same vein, if your goal is to reduce your profit in the current year because your tax rate next year is going to be lower, so you'd rather have that profit next year, okay, can you delay collections of that revenue, right? Maybe instead of putting a hard push on collecting that cash between now and the end of the year, can you wait until January, February to really collect on that cash? Again, for cash basis taxpayers, you pay the taxes when you actually get the cash. So that moves more of your profit into next year. Or if you're thinking about launching something new or doing a sale, maybe you wait until the first of the year to do that versus doing it this year. Obviously, you need to consider all your business and what makes the most sense for your business. But from a tax perspective, just think about those things when we're talking about collecting revenue and paying expenses. Okay, those are things that I am usually thinking about at this time during the year. Also, if your goal is to reduce taxes for the current year, then you definitely want to be maxing out any kind of tax deferred retirement plan. You could have a SEP IRA, a traditional type 401k or IRA. Okay, those ultimately you take the tax deduction when you put the money in. Now, when you take it out, you're going to get taxed. So that's the flip side of that, right? But again, if you think your tax rate is higher now, if your tax rate's really high now, and when you eventually take it out someday, you think it's going to be lower, that's a good time to put money into an employee plan like that. Now be careful though, because a Roth plan works the absolute opposite way. So a Roth IRA is actually going to be something where you don't get a tax deduction in the current year. However, it grows tax-free. So Roth may not be the way you want to go if the goal is to reduce your current year taxes. Okay, you can do both in some cases, right? So again, talk to a financial advisor about what makes the most sense. But from a tax perspective, contributing to a Roth will not lower your current year tax burden, but it could still be a good move going forward overall. So think about that when it comes to tax and retirement accounts. Typically, you have to have those retirement accounts open by the end of the year in most cases, but you have through the first few months of next year in order to make a contribution into it, okay? So that's something to know. If you don't have a retirement account like that, that could be a great, great thing. And some of them have really high limits. So look into a SEP maybe, or a solo 401k. Those are often good options for business owners. Talk to a financial planner, they can help you. So those are some of the main things I would tell you if you are in the situation of trying to reduce this year's tax bill. Now, here's the crux though. If you're in this, if the problem you actually have is that you just don't have the cash to pay taxes next year, it's not because you expect your tax rate to go down, but you just want to have the cash, then some of these things aren't going to help you, right? Because they're going to end up costing you more cash. You're going to have to put cash into your retirement plans. You're going to have to use cash to pay down expenses early, right? You are going to have to use cash, or you won't get cash as quickly if you're delaying the collection of your revenue. So that's something important to think about, is that if you don't have the cash, if you haven't planned and kind of set aside the cash to do these things, it might make it hard to take advantage of some of the potential tax planning, okay? I also want to mention, the goal is never to reduce your profit down to zero or an extremely low amount. Paying taxes is a good thing, Okay. That is a hill I will die on. Paying taxes is a good thing. Nobody would ever take, if you were offered two different jobs, one of them for $100,000 paycheck, the other one for $50,000 paycheck, right? Nobody is going to turn down the $100,000 job, all things being equal, because they pay more in taxes on that, right? You're not going to go with the $50,000 job because you don't have as many taxes to pay. No, you just want more money. So remember, we're not trying to get it so that you aren't showing a profit at all. If you aren't showing a profit, that usually means that you didn't actually make any money. So that's my soapbox. So the key there is, if the issue is cash flow, you want to be making sure that you're making estimated tax payments, or at the very least, putting money aside all year long so that when you get to tax time, it's already sitting there waiting for you and you're not having to play games to figure out how to lower a tax bill, but then you don't have any cash in order to take advantage of some tax planning. Okay? All right. Now let's say you're in Camp 2. Camp 2 is actually going to be typically more common, actually. Camp 2 is when next year you are expecting to be in a higher tax bracket because you're expecting your business to continue to grow. Okay? If that is you, then it actually flips the logic of tax planning. Now, this can be a little counterintuitive because it might mean we're actually going to be increasing our taxes for the current year, right? But over the long term, it's going to be better for us, right? We're going to pay less over the long term. So add the 2 years together and you're going to pay less overall. I would guess that for most of us, that is the goal. We don't want to pay less this year and a heck of a lot more next year, right? And continue to be in this game. So what we can do in that instance is, if we're actually in the place where we're like, you know what, I expect my business to actually grow, especially if you expect it to grow pretty substantially next year, that might be the time to do the opposite. Meaning, how do I pull some of that revenue into this year? How do I make sure I'm collecting? That's when you want to go into that collections frenzy and make sure that you're getting as much cash in the door this year as possible, right? It also means you might want to be delaying some of your expenses until next year. If you expect next year tax bracket to be higher, you want to have more expenses in order to offset that income if you're expecting to make more money. So that is a great thing to be doing in November and December, and is really sitting down and thinking about where do I want this profit, this year or next year? And then how do I make some changes or do things a little bit different or pay bills differently or collect, from customers differently? How do I do that in order to achieve the most tax advantageous answer? It isn't rocket science. So just think about your expenses, think about your revenue, and where do you have some levers that you can pull there, okay? And similarly, if you are in that spot where you're like, man, actually next year, this year, maybe your tax rate was really low this year because of some one-off things, or you're just getting started or whatever, if that's you, then it may make more sense, instead of putting a ton of money into a retirement account and getting a small benefit for it, because really, if your tax rate isn't that high, you're not getting that much benefit. And instead putting that money into a Roth IRA or maybe a 529 plan for your kids, which is not a tax deduction federally in the current year, but it grows tax-free. That might be a better time to put your money into that. Not saying it's a bad idea to put money into a traditional IRA or a traditional 401k as well. It's just what makes the most sense, right? You might want to max out and wait and keep that cash and use it for a contribution to max out for next year into a SEP or something like that when you're trying to lower your tax bracket. Okay, so those are the things to really be thinking about. There are others, but that is usually the process that I take when I'm coming towards the end of the year. It's also a really good time to actually figure out what is your income, right? Pull together what is your total income when you add up any W-2 wages, profit wherever you're at. If you don't know, this is a great time to get back into QuickBooks and figure out where your profit is at for the year and do some tax planning, and maybe sit down with a tax accountant to really talk about it, to make sure you have that money set aside so you don't have big surprises, because nobody likes a big surprise. If there's a big bill coming, that might be okay, but you want to be able to plan for it. That is the key. You want to be able to intentionally plan for it so that it doesn't have a massive impact on your cash flow or your emotional stability, right? Okay, so I hope this was helpful. Let me know if you have any questions. You guys are amazing, and I will be back for more tips. So make sure that you've subscribed to the channel and checked out the rest of my offerings. I'll see you later. Bye for now.